The Federal Reserve just announced emergency liquidity operations for 3 major banks. I need you to understand what that phrase actually means. It means the banking system is breaking again, and they're trying to fix it before you notice. JPMorgan Chase just moved $847 billion, that's billion with a B, off its balance sheet in the last 90 days. Bank of America quietly shuttered 152 branches in Q4 alone. And this morning, the FDIC updated its guidance on bank resolution procedures for institutions holding over $100 billion in assets. The 10-year Treasury yield spiked 47 basis points in 3 trading sessions. That's the fastest move since March 2023. Credit default swaps on major U.S. banks are trading at levels we haven't seen since the regional banking crisis. And if you look at the yield curve, the inversion that everyone said predicted a recession, it just uninverted. Historically, that's not when the recession gets canceled. If you have money in a bank account, if you're invested in bonds, if you hold cash thinking it's safe, if you're waiting to buy the dip in stocks, you need to understand what's happening in the next 72 hours. Because the financial system is sending signals that most people won't see until it's too late. I'm going to decode them for you right now. For those just joining, I break down macroeconomic data, monetary policy, and market structure to help you understand not just the headlines, but what they mean for your wealth. I don't sell courses. I don't push products. I give you the information institutions are trading on before retail investors even know it exists. Today is mid-January 2026, and over the past 2 weeks I've been tracking something that started as a small anomaly in overnight lending markets and has now spread into a full-blown liquidity crisis that nobody in mainstream media is talking about. Let me walk you through exactly what's happening, and then I am going to share what I think is coming in the next 30 to 60 days, because the official narrative and the actual data are telling completely different stories. On January 2nd, the Federal Reserve's reverse repo facility, which is basically where banks and money market funds park cash overnight with the Fed, dropped below $200 billion for the first time since 2021. That might not sound important, but it is. And the fact that it's now effectively empty means that liquidity has been drained from the system. On January 7th, 3 days ago, the overnight lending rate in the repo market, where banks lend to each other, spiked to 5.8%. The Fed's target rate is 4.5%. A 130 basis point premium means banks don't trust each other enough to lend at normal rates. They're charging a fear premium. When banks are afraid to lend to other banks, that's not a small problem. That's a systemic problem. And then yesterday, January 9th, the Fed announced what they called routine liquidity operations for 3 undisclosed financial institutions. They won't say which banks. The Fed does not do routine anything on a Thursday afternoon. When they move outside their normal schedule, when they refuse to name the institutions, when they use words like precautionary, what they mean is we're trying to prevent contagion before the market panics. Now, I've been digging through bank filings, and here's what's showing up. JPMorgan's latest 10Q shows they moved $847 billion in held-to-maturity securities off their balance sheet through a series of complex swaps and transfers. Why does this matter? Because held-to-maturity securities are bonds that banks bought when interest rates were near zero. They're supposed to hold them until maturity so they don't have to mark them to market. But if you're moving them off your books, it suggests you're either trying to hide losses or you need to free up capital for something urgent. Bank of America closed 152 branches last quarter. Wells Fargo closed 93. Citigroup closed 87. This isn't about digital banking. This is about cutting costs because revenue is collapsing. Net interest margins, the profit banks make from lending, are at 15-year lows. They're not making money anymore. The FDIC just updated its procedures for resolving large banks. That's the playbook for what happens when a bank fails. They don't update that document unless they think they might need to use it. The last time they updated it was February 2023, 1 month before Silicon Valley Bank collapsed. Let's talk about what the bond market is telling us, because this is where it gets really interesting. The 10-year Treasury yield was at 4.21% 2 weeks ago. Today it's at 4.68%. That's a 47 basis point move in less than 10 trading days. For context, a 10 basis point move in a week is considered significant. We just did almost 5 times that. There are 3 possibilities, and none of them are good. First, the market might be pricing in higher inflation expectations. If inflation is coming back, bonds lose value and yields rise. Second, foreign buyers might be stepping back. China and Japan have been net sellers of U.S. Treasuries for 3 consecutive quarters. If they're not buying, yields have to rise to attract new buyers. Third, and this is the one that worries me most, there might be forced selling. If banks or institutions are facing margin calls or liquidity squeezes, they sell their safest assets first. Treasuries. Here's why this matters for you. The average 30-year mortgage rate has jumped from 6.1% to 6.9% in 2 weeks. If you were planning to buy a house or refinance, that window just closed. A half-point increase in mortgage rates on a $500,000 loan costs you an extra $175 per month. That's over $2,000 a year, over $60,000 over the life of the loan. But it's not just mortgages. Corporate borrowing costs are rising. Credit card rates, which are already at record highs, are going higher. Auto loans, student loans, everything tied to interest rates just got more expensive. And if borrowing costs keep rising, consumer spending contracts. When spending contracts, corporate earnings fall. When earnings fall, stock prices eventually follow. Now let me talk about what's happening in the credit markets, because this is where the real stress is showing up. High-yield corporate bonds, also called junk bonds, just saw their spreads widen by 90 basis points in 1 week. That means the extra interest rate companies with poor credit have to pay over safe government bonds just jumped almost a full percentage point. When spreads widen that fast, it means investors are demanding much higher compensation for risk. They're getting scared. Investment-grade corporate bonds are also showing stress. Apple, Microsoft, Google, these are some of the safest corporate borrowers in the world. But even their bond yields have risen 30 basis points in the past week. If the safest companies are seeing their borrowing costs rise, imagine what's happening to everyone else. Credit default swaps, which are basically insurance policies against a company or bank defaulting, are spiking. CDS on Bank of America are up 18% this week. JPMorgan up 22%. Goldman Sachs up 31%. These are not small moves. When CDS prices rise, it means the market thinks the probability of default is increasing. I want to be very clear about something. I'm not predicting that these banks will fail. These are some of the largest, most systemically important financial institutions in the world. But what I am saying is that the market is repricing risk. And when the market reprices risk this quickly, it's usually because something is breaking that hasn't been announced yet. Here's my working theory. And this is speculation based on data, not confirmed fact. I think there's a medium-sized bank or a large non-bank financial institution that's in serious trouble. Maybe it's a private equity firm that over-leveraged on commercial real estate. Maybe it's a regional bank that has massive unrealized losses on its bond portfolio. I don't know which one, but the pattern of liquidity operations, spiking repo rates, widening credit spreads, all of it points to stress in a specific corner of the financial system. In 2008, the crisis started with subprime mortgages, but it spread to the entire system because banks are interconnected. In 2023, it started with Silicon Valley Bank, but it spread to First Republic, Signature Bank, Credit Suisse. When one institution fails, counterparties get nervous. Let's talk about what this means for stocks, because the S&P 500 is still near all-time highs and people are confused. How can stocks be at records while the banking system is showing stress? The answer is concentration. The S&P 500 is weighted by market cap. The top 10 companies represent over 35% of the index. Apple, Microsoft, Nvidia, Google, Amazon, Meta, Tesla, these 7 stocks are holding up the entire market. If you look at the equal-weighted S&P 500, where every stock counts the same, it's down 4% from its recent high. The average stock is falling. You just can't see it because the mega caps are so large they distort the index. But here's the problem. Those mega cap tech stocks are not immune to a financial crisis. If the credit markets freeze, if banks stop lending, if liquidity disappears, those stocks will fall too. It might take weeks or months, but they will eventually follow the rest of the market. Bank stocks are getting destroyed. The KBW Bank Index, which tracks major U.S. banks, is down 7.3% in 5 days. That's a bigger drop than we saw in the initial days of the Silicon Valley Bank crisis. The market is telling you something. Listen. Now, I need to talk about commercial real estate because this is the elephant in the room that nobody wants to acknowledge. There is over $1.5 trillion in commercial real estate debt maturing between now and the end of 2026. These are loans that were made when interest rates were 2% or 3%, and they're coming due now when rates are 7% or 8%. Property owners can't refinance at these rates. Office buildings that were worth $100 million in 2021 are worth $40 million today because nobody's working in offices anymore. And what happens when they can't refinance? And when banks take losses on commercial real estate, they have to reserve more capital, which means they lend less, which means the economy slows, which means more defaults. It's a vicious cycle, and we're at the beginning of it, not the end. Here's what I think happens over the next 30 to 60 days. We're going to see at least one major financial institution either fail, be acquired under duress, or receive a government-backed bailout. The Fed will cut rates in an emergency meeting outside their normal schedule. They'll restart quantitative easing, which means printing money to buy bonds. The stock market will have a violent downdraft, probably 10 to 15% before the Fed steps in. And gold, which is already at record highs, will go even higher as people flee to safety. I'm not saying this to scare you. I'm saying this because the data supports it, and you deserve to know. The FDIC updating bank resolution procedures, the Fed conducting emergency liquidity operations, Repo rates spiking, credit spreads widening, bank stocks collapsing, the yield curve uninverting. All of these are warning signals. Individually, they might mean nothing. First, check your bank balances. FDIC insurance covers $250,000 per depositor per bank. If you have more than that in one institution, spread it out. Second, if you're heavy in stocks, especially in regional banks or commercial real estate, consider taking some risk off the table. I'm not saying sell everything, but don't be 100% exposed when the warning lights are flashing. Third, look at assets that do well in financial stress. Gold is obvious. Short-term Treasury bills are safe. Cash is fine in the short. Inflation will eat away at it. And fourth, be patient. If we do get a market downdraft, that's when generational buying opportunities appear. In March 2020, the S&P 500 fell 35% in 4 weeks. If you bought at the bottom, you doubled your money in 18 months. In March 2023, bank stocks fell 50%. If you bought the survivors, you made 80% in 6 months. Crisis creates opportunity, but only if you have dry powder and the courage to act when everyone else is panicking. Let me be very clear about one thing. I'm analyzing probabilities based on data. Maybe the bank that's in trouble gets quietly rescued. But as an investor, as someone managing their own wealth, you have to prepare for possibilities, not just hope for the best outcome. The financial system is extraordinarily complex, and when complexity meets leverage, meets interconnectedness, bad things can happen very quickly. We saw it in 2008. Do you think we're headed for another banking crisis? Are you moving money out of regional banks? What's your strategy if the market drops 15% in the next month? I read every single comment, and I learned from you just as much as you learned from me. If this breakdown helped you understand what's really happening behind the headlines, smash that like button. If you want daily updates on this situation as it develops, hit subscribe and turn on notifications, because this story is moving fast and you need to stay ahead of it. The difference between protecting your wealth and losing half of it comes down to information and timing. Don't be the last one to figure out what's happening.